Hello and welcome to Crux Investor. We caught up with Brendan Yurik, CEO of Electric Royalties today. Spoke to them back in March and they come back to tell us today how they've managed to get one of their deals over the line. Sometimes you can do it easy and sometimes you just have to get it done. Done a deal with Sprott, raised the money they need to buy the royalty we were talking about back in March. Plus they've done 2 deals with Vox Royalty as well. So well done them. If you want our thoughts and opinions on the conversation, you can find that at cruxinvestor.com. And if you want to see precisely what we talked about, do take a look in the description below. Brendan, how are you, sir?
I'm doing well, Matt. How are you doing today?
All good, all good. Coming to the end of a long day here. You're looking very slick, a gorgeous visage in black. Looking
cool. Well, I appreciate that. No, the day's just getting started here, so you're at the end. I'm at the beginning.
Yeah,
it's good to see you again, though.
Yeah, and that's good to see. When did we catch up? End of March, I think. It was you're kind of the new kid on the block.
Yeah, we were a new kid on the block. We just signed our first cash farm royalty acquisition. And your big question mark to me was, how are you guys going to finance this thing? So,
well, you're going to answer that today. We're going to talk through that today. But we should, before we do that, let's kick off. Give people a new to the story, 1-minute overview of the business, and I'll pick it up from there.
Yeah, sure. So, Electric Royalties is the only royalty group out there really focused on the entire suite of metals required for the transition to clean energy. And what you're really talking about is rebuilding the global infrastructure, towards a decarbonized global economy, which is going to have a big impact on a lot of different metals. They're relatively small markets today, and that's kind of where we're focused on. We are the only group out there that's doing that. We managed to put together a portfolio today of about 16 royalties, 2 of which are cash flowing, producing, or care and maintenance. And one is, our flagship lithium royalty should also be entering production, kind of 12 months out. So we've got, a good mix of, advanced stage assets, producing assets, and really just getting going. We went public, basically in the middle of COVID last year. And so just ramping up and, it's an exciting time for sure.
It is indeed. It is indeed. Okay. I did ask you a big question last time out, was basically how are you going to finance one of the royalties, which you said to me it was in the bag. It's a sure thing. It's definitely going to happen, but you had to go and get the money, right? So I saw you made an announcement about raising capital, but then you went and did a slightly more funky structured deal with Sprott.
Yeah. So the way we did that, I saw this as the way we're playing this is we want to stay diversified across all these key commodities. And that way we're not really making a bet in terms of where battery chemistries are going to go, which technologies may come in and disrupt the sector. They all have exponential growth forecasts. And so if you stay diversified, even if 1 or 2 kind of drop out, you're still getting exposure to that whole EV space. And so I'd be a big hypocrite if I said that. And then we went and did a deal where we put, $20 million into one, project, when we're basically a $20 million company today. And so, we always intended that we were going to bring in a co-investor, someone that, fund just like Sprott. That's ultimately who we did bring in to come in alongside of us and actually put up most of the cash portion, for the deal. So we actually did end up kind of going through a couple of renegotiations, but we did just announce about 2 weeks ago now that we've renegotiated that. Sprott's actually putting up 100% of the capital or cash now. They're going to come in and initially acquire 75% of the royalty alongside of us. We're going to get 25% up front in exchange for basically 9 million shares of Electric Royalties. And we're going to have the option to buy that another 25% back from Sprott, basically at a 10% bump from today at the end of year 1, at the end of year 2, minus the cash that they actually receive for that 25% beneficial interest. So, ultimately pretty much of where they're paying today. And so that actually fully finances us now to close that first cash flow royalty acquisition and move ahead. So we did announce a $10 million equity financing, about a week or 2 before that. And essentially we had to complete initially a $10 million equity financing to close that deal. As part of this restructuring renegotiation, we no longer have to do that. We are going to go do a smaller equity raise, bring some more key investors in, and top up the till. But it removes having to do 10 million today, which would be a big dilution in and of itself. So it's exciting. We're now fully funded to close our first cash flow royalty acquisition. And really built a partnership with Sprott as well. So it's exciting.
Yeah, and it sounds like a very typical Sprott deal. We've seen a few of those. So one, congratulations on getting a deal done. It's about getting something done, however you need to get it done. Okay, so congratulations on that. But what have you learned from that? Because what you said to me last time was, I'd ideally not like a strategic partner, and I think we can go and raise this money. So you weren't able to do that. So what are the kind of big learnings for you from this?
Well, it's about size for me, honestly. At this stage, the toughest part, quite frankly, is staying diversified as you grow, right? If you look at things at a point in time, you can argue at the end of the year, maybe we're not diversified if we stick through the whole year. But, today, this is just too big of an asset to go get, relative to our size. So it makes total sense just given, the relative size of it today. And if you're going to go after an asset like this, right, we wanted to get the right asset. You're not going to get a producing asset or get your teeth into a producing asset unless you put up a big check size. This has got traffic year it's in the US, 50 years operational history, long mine life ahead. And it's a real big mine. It's a mining complex. And so, we had to pay up to get the right asset and get exposure to the right asset. But it's about relative size today. Ultimately right now, this is a good tool for us, the co-investment strategy to get into better assets that we'd like, ahead of when we actually could, on our own.
Okay, so the deal was that, so right now Sprott put all the money up. They have 75% of this. You've got 25%. You haven't put any money up. Seems good so far. But so remind me again, the cost of acquiring within a 2-year period, I'm guessing is what I heard, end of year 1, end of year 2, 25%. What's that going to cost you again?
Yeah, it's I think it's about 4.35 million, something around there.
Right, okay.
And ultimately, it matters a little bit in terms of what the cash that they receive from that 25% interest is over the next year. But yeah, it's about there. And ultimately, we're paying 9 million shares now. Now, I should mention also, there's actually 2 royalties that we're acquiring in that portfolio. So Sprott's actually putting up about 80% of the total acquisition cost now. And we're getting 2 royalties back. So we're getting 100% of the Glassville manganese royalty as well. So it's actually a portfolio deal that's kind of now a throw in for us. But yeah, no, it's exciting. It's ultimately a much better deal than when we first kind of signed this and started out. And, it's exciting to be working with Sprott. Like I said, this isn't going to be a long-term thing. At a certain time, we're going to be a big enough size where we can take on assets like this, where it makes sense. And we're not, betting too heavily into anyone. But where we're at today, I think it's a perfect tool, to help minimize dilution at this stage and still get exposure to those assets that we want.
Okay. When I said, what have you learned? You talk about diversification and that's all good as well. It's all good. But I just want to dig down here. So I was kind of coming at it from the point of view, what have you learned in terms of the ways that you can structure deals to allow you to be able to compete differently? No one wants to overpay, but at the same time, you've got to be flexible in your attitudes to the way that deals get put together. Did Sprott being part of this deal allow you to renegotiate a slightly better deal, or do you think you could have got there yourself?
Well, I think we got there ourselves. I don't think Sprott could have cut that deal, quite frankly. That was more of a, relationship between us and Globex and Jack. But, ultimately having them there and having their name behind it is, credibility in terms of they have the funding. So from that standpoint, it does help. But, quite frankly, this isn't the type of deal that Sprott themselves could kind of go in as well. And so there's definitely some value add that we can bring to the table. Because our problem is not deal flow. And there's a tremendous amount of capital out there, looking to do deals and would love to deploy, especially in royalty deals, like the ones that we kind of put together. So, I think it's there's opportunity to maybe maximize some of that value that we get out of this in the future. This was ultimately our first one, so we wanted to get it done, establish the partnership. What this really allows us to do, though, quite frankly, is, we want to go create new royalties. Now, that's very tough if you're a company that has no track record of, putting it together a much larger financing than, you could typically take on at your size. This is a perfect example of us being able to syndicate a bigger financing. And so now we can actually go in and write, new financing term sheets for groups. And, because we've just shown that we can go put a deal together like this pretty quickly, that actually allows us to do that. Right. And when you're talking about new financing term sheets, it's very hard for people to get, or hard to get people to, sign something where you're saying, hey, I'm going to bring new financing to create a new royalty or, to fund you through if you don't look like you have the capability to actually fund that. And so for me, that's really the kind of the exciting piece. Because I think that's going to be where a lot of the value creation is really over the next kind of 1 to 3 years. So it's a stepping stone, right? You got to, build the company one piece at a time.
It is a stepping stone, and you're right. There are lots of deals out there, and there's lots of cash out there. I guess the skill is being able to structure the deals in a way which makes the most sense economically for you and your shareholders. Cash on cash returns. We talked about that last time. Some of the deals that you're doing initially, are they going to be just that little bit more expensive out of necessity to build scale, or are you conscious of these kind of ratio, the usual ratios you're looking for cash on cash return on all your investments, aren't you?
Yeah, well, look, I'd like a return on all of our investments, and I'm not going to tell you exactly what our IRRs are on some of them internally, but they're very good. And so, ultimately, yes. Look, I think we're going to be creative every time we go out. I mean, I think it's worth it for us, especially to just make sure we try and maximize the terms that we can get on these. I mean, we're looking at, what we can do to kind of minimize dilution at this stage, because, we're grossly undervalued where we are today. I think we're trading about pro forma will be at about, 0.3 times NAV. Peers are trading at kind of 1.3 times. And so there's a big, value gap there. And so we want to minimize dilution as much as we can while we're getting enough size to, basically get re-rated, fully on the portfolio that we already have. And so we're looking at stuff like, convertible debt acquisition facilities. The co-investment is a great, piece that we've just kind of showcased here. But, we're definitely trying to minimize dilution and be creative on the financing package put together.
Right. Okay. You've also done a deal with Vox Royalties recently.
Yeah. So that's an exciting partnership, really.
Yeah, they're a really good company, So what have you picked up there?
Yeah. So we're picking up 2 graphite royalties. One, I'm basically going to call it producing. It's listed as producing on their website. It's on care and maintenance today, but that's really just because of COVID restrictions in Madagascar. But they produced for 20 continuous months at Graph Mada. That all of their product was qualified by off-takers. And it's a very good, flake distribution there. Madagascar is one of these kind of special places for graphite. You saw Mick Davis made a big investment into NextSource, the last kind of 3-6 months. And this is really one of 2 ASX listed companies that's actually capable of producing graphite today. It sounds a little crazy, but that's just kind of the space where we're at today. We already have royalties in and around the only producing lithium mine in Canada, the only manganese district in North America being developed in the EV space. So one of 2 ASX listed companies actually capable of producing graphite. This gets us initial exposure. It does have a cap on it of 5 million Australian dollars. We're only paying 2.8 million cash shares. So there's still some upside there, but ultimately we plan to go renegotiate that. They're going to need more capital to expand production. They're looking at a ramp up of 6,000 to 20,000 tons per year. But that's another cash flowing asset that should start producing again, the start of next year. And then we're also picking up a high grade graphite resource in Australia, but that's a royalty on a high grade resource in Australia, but that's really just part of it. I mean, these guys have a kind of, a secret sauce, as it were, in some respects. They picked up a proprietary database. It's got over, 8,000 existing royalty opportunities. That's not an area that we really focus on. Like I said, we really want to be new, creating new royalties out there. And so, it's fantastic to have a partner that already has, all of the work done in this space. Their investors and their company is really built towards precious metals. And so, for them, it's kind of, we have all this deal flow. How do we monetize it? And we're kind of the perfect partner for that. And so basically it lets them create some value for the deal flow that they already have. But they've been the fastest, like the precious metal royalty sector is very competitive, and they've been the fastest growing group out there that I've seen, especially among the new entrants. I think they picked up, 30, 40 royalties, 15, 16 different deals over the past kind of year and a half. And so they do have, they've kind of streamlined that part of it. And so it's going to be an exciting partnership. It won't be the last deal that we do together. And, we're definitely going to be working and collaborating with those guys, more moving forward. But, another, 2 royalties, one that'll be producing starting next year, and an all shares transaction, but really the start of a partnership. So cool. I'm excited about that. No, it's,
they're great
like
group.
The team over there.
They're a great group. We know those guys really well. In fact, they're definitely, the pick of the bunch on the royalty side. But how do you structure a deal with a group like that? So obviously they've got this database, they've got lots of royalties in there, and they want to focus on precious metals. It's fantastic. But you've just given them, 2.85 million Canadian dollars worth of shares in your company. So I assume there's a massive long hold period, or you're paying that out over a long period of time. And Talk about the detail of the deal.
Yeah. So whenever we're giving shares away to a group like this, to a vendor, we always place, we put typical restrictions in place on the shares in terms of when you can sell them, what you have to, do you have to communicate with us that you're going to, do we get a period of time to place that at a discount, with other investors, which ultimately I do think is actually going to be helpful for us down the road as we're trying to bring in some bigger funds. And so there's always stuff like that. Ultimately, they actually approached me with the idea. And it's funny because I'd already approached most of the other royalty groups out there. I talked about collaboration, and I hadn't chatted with these guys, but they came to me and basically pitched on the idea that they wanted to do this. They wanted to monetize the deal flow. And ultimately, what they're planning is to actually dividend our shares out to their shareholders as kind of a dividend policy. Okay. And so it's very interesting. I like the idea, quite frankly, in lieu of doing a cash dividend, especially at a time like this where you're still just growing, to be able to give a dividend out in, exposure to another type of royalty company to your shareholders. I think there's a lot of value in that. And ultimately it's them kind of just going, they have the deals, they already know where they are. They've streamlined this existing royalty consolidation process, so they can kind of move the ball down the, field a bit for us, do a little bit of that legwork, and then bring us deals, talk to us, see if we like them, and work out some type of, shares consideration, that works. So, yeah, I mean, we're still kind of working through it. Like, this is our first one. And, there's not too many other, royalty partnerships kind of like that. So, we're pioneering it a little bit, as it were. But, that's kind of the general basis of what they're planning.
Right. I think that'll be a really interesting one to watch and sort of see how that partnership develops. But yeah, let us know how that goes, obviously. Okay, you come back on, you told me how you financed it, you got the deal over the line, a little bit of wiggling around and restructuring, and it's happened. So well done.
Yeah, thanks, man. I appreciate that.
Okay, what next?
Yeah, well, look, I mean, we are going to close out a smaller equity raise here in the near term. But ultimately, I want to get back out there, working on new deals. We basically had to put stuff on hold. You can only take so much on your plate at any given one time. And so, $20 million deal on your plate and having that outstanding, you kind of have to get that, at least, across the line into completion before you worry about the next thing. But, quite frankly, we're hoping to go get, another 3 or 4 producing royalties, ahead of having to actually go back and raise equity and dilute again. And like I said, we got co-investment options. We've, got our shares capital, which we've been, proven to use pretty well. We're looking at convertible debt acquisition facilities, that type of stuff. So we actually think we can go get another 3 or 4 producing royalties, over the next kind of 2-3 months. And, we've got a couple of royalties in our portfolio that are going to be, entering production naturally, over the next year or two. And so, we're well on our way to getting a diversified portfolio of cash flowing producing royalties that's going to, provide capital to the company, allow us to actually put a, credit facility together. We're probably going to be able to pick up another 8 to 10 development stage royalties as well before we have to go back to equity markets. So it's going to be busy. It's about M&A. What's next? M&A. Creating new royalties. We are going to go get some copper and some tin and some nickel exposure as well, just to round out the those are commodities we're interested in. We don't have exposure to those just yet. And so we're going to go be taking care of that over the next 3 months. I know the market really is appreciating copper and nickel and not so much tin, but, tin is going to be an exciting one, I think, as we move forward. Prices are already up 50%. I think they probably, are not even halfway where they're going to eventually hit. But so that's kind of the game plan right now, but excited to get back to that piece of it. I mean, for me, that's the fun part,
Brilliant, Brendan. Well, stay in touch. Let us know how you get on. I say well done on closing the deal. It's what it's about. Okay. Speak to you soon.
Awesome. Thanks, Matt. I appreciate it.